Okay, hey guys, Scott here again with a brand new video, and this one we're going to focus on Bed Bath & Beyond here, which is of course the hottest new meme stock right now, but also we're going to focus on just meme stocks in general for this video, and in particular why buying put options on these stocks to play for their eventual fall back down to earth, right? Because of course these stocks always come back down eventually, but why buying put options on these stocks is not the right way to do that. And so I'll be showing you guys why that is the case, both through some analysis here in thinkorswim, and then also through a basic option pricing simulator that I program with some basic Python code that's going to very clearly show you why, again, buying puts on meme stocks is not the right way to play for their eventual fall back down to earth. Now, real quick here, if you guys want to receive up to 13 free stocks where each stock could be worth up to $2,000, then make sure you watch until the end of the video. And then also, for anybody who would like to join a very exclusive online community where you can learn how to successfully trade options and learn my custom approach to the markets, then you can now join my options trading Discord. So definitely make sure to check out the description of the video below to learn a lot more about that. And then finally here, for anyone who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you join Skillshare using those links, you'll get a full 1-month free trial. All right, guys, so now we'll dive in here. And first up, let's take a look at the charts here for Bed Bath & Beyond in thinkorswim real quick. So obviously, it's no secret by now that this stock has undergone a massive short squeeze and has basically exploded by hundreds and hundreds of percent. And then, of course, like I was mentioning earlier, at some point, these meme stocks always come back down to earth and typically do so very quickly. But take note, though, that yesterday, this stock closed at right around $23 per share. And right now, Bed Bath & Beyond is down to $18 per share. So that basically means this stock right now is down by about 21.5%. That's a huge, huge drop. But if we go to the trade tab real quick and take a look at the option chain for Bed Bath & Beyond, and for example, let's go into the September monthly cycle with 30 days left to go, unfold this tab here, and then over here with the put options, again, this stock closed yesterday at $23 per share. So even if you bought an at-the-money put option with a 23 strike, then today you would only have a profit of about $100. That's it. And again, keep in mind, this stock is down by over 20%. So of course, one might think that in such a situation that if you did buy an at-the-money put option, then the next day you should be making a lot of money. Or what about also these out-of-the-money contracts still, right? Maybe instead of buying an at-the-money put option contract, let's say you bought the 15 strike, in which case today with the stock being down over 20%, you'd only be up by about $55. And moreover, given that Bed Bath & Beyond has already come down by the majority of its huge up move at this point, of course, obviously, there's more downside to come here, but I would imagine that the stock is going to start slowing down a little bit here. And if that happens, then I definitely would expect that, again, even with the stock coming down further, that these put options here are actually going to start losing value, in which case all these put option buyers are going to be losing money. Now, why though is this the case, right? If you buy a put option and then the stock drops by a huge amount for multiple days after that, you would expect to make a lot of money. But as you can see here with the option chain, your profits are either going to be quite small or you may still actually lose money in the end. And so there are two reasons for that. Number one, implied volatility, and number two, the actual price of the stock. So for example, if we come back to the charts real quick and come down here, this chart shows you the implied volatility for Bed Bath & Beyond over the past 1 year. And in case you're not aware, implied volatility here is used in part to price option contracts. And basically, this is a measurement of uncertainty about the future, in this case for Bed Bath & Beyond. And most importantly, when implied volatility expands like this, or there's more and more uncertainty about the future, then option prices will go up along with it. And then conversely, when implied volatility contracts, option prices go back down. Now, in most cases, the relationship between implied volatility and how the stock price moves, there's typically an inverse relationship. So for example, if we go to SPY real quick, which is an ETF that tracks the S&P 500. So typically, as you can see here, when stocks go up, implied volatility goes down. And then conversely, when stocks go down, implied volatility usually goes up. And hopefully that should be a bit intuitive, right? Because again, if implied volatility is basically a measurement of uncertainty or fear about the future, and people in general typically get scared or more uncertain when stocks go down as opposed to when they go up. So again here, that's why in the vast majority of cases, stocks and implied volatility move in opposite directions. But in the case of meme stocks, so back to BBBY here, that relationship is basically flipped on its head. So in this case here, as Bed Bath & Beyond has moved higher, so has its implied volatility. They're now moving in the same direction. And hopefully also this should be a bit intuitive as well because again, implied volatility measures uncertainty, and it seems kind of natural, of course, when stocks go crazy like this, there should be increased amounts of uncertainty for this stock's future. But now this also means that when the stock does finally come back down and starts to stabilize, and therefore there's more certainty about what the stock might do in the future, you're going to see the implied volatility for Bed Bath & Beyond come down significantly as well. And keeping in mind how implied volatility affects option prices, again, when implied volatility goes up, option prices go up, but when implied volatility goes down, option prices go down as well. And so therefore, if you buy put options on stocks like this, even if you get the directional move correct and the stock comes down significantly, the IV contraction and therefore the contraction of your options price may still offset the gains that you could have made from the stock decreasing. And then on top of that, another factor which gets used to price option contracts is the actual price of the stock. And specifically, the cheaper the stock price, then the cheaper the options as well. And so bottom line, the big picture now is the gains you'll make on buying puts when the stock comes down, that correct directional move in your favor, those gains could be offset partially or entirely by the rapidly decreasing stock price and also the rapidly contracting implied volatility. And that's why, as you saw earlier in this video with the option chain for Bed Bath & Beyond, the prices of those put options are hardly up at all. And just to illustrate my point even further, let's now come over to this page. And as you can see here, this is the basic Python code I wrote up, which allows me to run a basic option pricing simulator. And so basically the way this works is my code here is going to simulate the price of some random put option before the collapse of Bed Bath & Beyond, and then the price of that same put option after the collapse in the stock price, and also after the collapse in the implied volatility. Right, so for example, if we come back to thinkorswim real quick here, we can see that Bed Bath & Beyond got to a high of around $30 per share, and then also the implied volatility got to a high of just over 300%. And so with that in mind, we'll come back to our code here and configure a few of its settings. And so for the first example, we'll say the original stock price for Bed Bath & Beyond is $30. As you saw in the charts, that was the highest price it got to. And then also the current price for that stock right now is about $17 per share. So it's already fallen by almost 50%. Now the strike price for the put option we're going to simulate here, we're going to assume you bought an out of the money put option with a 20 strike, which definitely is a very common thing that many people do when trading meme stocks. They buy out of the money options. And then also this R here, this R variable stands for the risk-free interest rate, which right now I've set to 0.01 or 1%. And then also for this put option, we're going to assume the original DTE or the original days to expiration is 35 days. And now the current days left until expiration is 30 days, right? So basically only 5 days have passed since you bought that put option. And then also, as you saw in thinkorswim, the original implied volatility at the highest point was about 300% or 3.0 in terms of a decimal. And now the current implied volatility for Bed Bath & Beyond is 275% or 2.75. And so now with those settings configured, we'll come to the top here and click on the play button to run the code. And so as you can see down here with the output of the simulation, the original put price before the stock collapsed and before the implied volatility contracted a little bit, the original price was $4.70 on a per share basis. So in total, the full price is $470. And then now afterwards, the current price of that same put option has actually increased to $7.27. So definitely not bad at this point. You have made a small profit. That's pretty good. But now what if you wanted to hold this contract for longer to see if you can make a bigger profit? So now back to our settings here. Let's say we fast forward time, and now the current days left till expiration is only 10 days. And at that point, the current stock price has fallen even further. We'll say down to maybe 14 bucks per share. So that's another almost 20% decline. And then the current implied volatility at that point has also fallen down to maybe 175%. So let's see what happens in this case. And so there you go. The original put price has stayed the same at 4 bucks and 70 cents, but now the current put price has fallen down to only 6 bucks and 25 cents. So in this scenario here, the stock price still fell by almost another 20%, but you still lost money. Of course, your put option is still net profitable, but you have given back some of those profits. And that's again because the stock price is now smaller. Of course, time has passed as well, and time decay always hurts you as an option buyer, but mostly the implied volatility has contracted a lot more. And this exact kind of situation is made worse and worse if you go further out of the money, right? So for example, if you instead bought a put option with only a 15 strike, which is still plenty higher than the stock price was before the massive short squeeze, right? Bed Bath & Beyond was only at about 6 bucks per share. Well, in this case, let's see what happens. And here we go. So the original put price is 2 bucks and 44 cents. And then after the stock fell, implied volatility was crushed and time decay did its thing, the price of the put option has actually fallen from 244 down to 221. And don't forget, at the time you bought this put option, the stock price was 30 bucks per share, and now it's only 14. So that's a decline of over 50%, right? So you got a massive directional move in your favor on these put options, but you still lost money. And so that's why, in my view, the best way to trade these kinds of meme stocks when they eventually do collapse is not to buy put options, but instead to sell call options. And you can do that by either selling naked call options, which is definitely pretty risky with these kinds of meme stocks. So a better approach would be to sell call credit spreads and therefore basically cap or limit your risk. But if you do sell out of the money call options, then you will actually benefit from those very same things that cause put option buyers to lose money, right? So when you sell options in general, you want the prices of those options to decrease in value. That's how you profit, right? So when you sell out of the money call options on meme stocks, they will profit, meaning their prices will decrease when the stock price falls and gets smaller and smaller and smaller, and also when the implied volatility contracts as well. So for example, if we now come back to the trade tab real quick here and take a look at the prices of these call options now, and specifically how their prices have changed compared to yesterday. And so once again, keep in mind that yesterday, Bed Bath & Beyond closed at a price of 23 bucks per share. And now today, with the stock being down by over 20%, this call option with a 23 strike has dropped in value by over 400 bucks. Whereas compared to the exact same strike put option, this contract has only gained in price by about 100 bucks. So therefore, if you bought this contract, today you would profit by 100 bucks, but if you sold this call option yesterday, then you would profit by about 400 bucks, 4 times more. So bottom line here, guys, I hope this proves to you why selling call options or call credit spreads is a much better approach to play for the eventual downfall of meme stocks than buying put options. Right, so don't forget how dynamic option pricing is. There's a lot of things that go into pricing a contract, like implied volatility, the stock price, time decay, interest rates, etc., and you have to keep all that in mind when you're making trades. So again, when it comes to meme stocks, my general rule of thumb is to simply avoid them altogether, but if you really do want to trade them, then again, the best way to do so, at least for their downfall that is to sell call options or call credit spreads. And so with that being said, that's going to do it here for this video. But of course, one last thing, as I mentioned, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.